George have gone through a couple of areas there of ideas for land diversification, which is what all this is about. I'm going to talk briefly about money. We work with lots of companies providing money, and more asset finance companies particularly are engaging more in renewable energy products and renewable energy technology. So I'm going to briefly run through that, and then I'm going to show you 2 or 3 recent case studies so you can get a feel for what a particular project would look like. Okay? So, funding options for anybody who's got their own farm or businesses. There you go. So there's banks, there's private equity, challenger banks are out there now. You've got your own working capital through cash. And asset finance is traditionally more linked with things like HP for cars, for trucks, for tractors, these sort of things. But as I said, more and more banks now are looking at and specialising in asset finance for renewable energy products. And whilst George has gone on a few of the products there are a number of areas where these guys are really looking to get into renewable energy products. And these are the main ones we do. We do plenty of them. Solar, as we've already discussed, because of the nature of the reduced or almost the FIT income has basically been reduced down to nothing. There's less and less solar, but we're finding plenty of activity in AD plants and biogas, as George suggested there. We're still funding biomass projects, and onshore wind, again, is another area we're looking at where we're funding, and I've got one of the case studies I'll show you there as well. So all these technologies, all these things that you might look at as a way of diversifying your income streams are fundable through the market at the moment. So 2 or 3 areas where we cover. So asset finance is lending to an existing business. That may be a farm, whether it's held in a partnership or a sole trader or limited company. We do project finance, so where it's a standalone project, there's no business effectively behind it, but the project itself has got financial wherewithal to support the lending into it. And there's refinance, so if you already have an existing project, if you put a solar proposition in a few years ago at very high pence per kilowatt, what businesses are now doing is saying we'll refinance that for you so you can take some of the money out to reinvest into different projects. And we're finding that's becoming more and more popular because many people invested in solar at high rates still want to reinvest some of that money so we can take it out of those solar projects. Still the debt servicing works because the kilowatt hour you're earning on that is still very high, which allows you to reinvest into other areas. So that's another thing that's is more and more popular at the moment. Okay, so let's run through these 3 case studies. So, the first one I've got is that these are all case studies we've actually written in the last month or 2, so they're all very relevant. So it's quite small on there. Luckily I'm close so I can read it. It's a biomass system for a commercial business. It's a recycling business, so it's not agricultural, but they're linked. They've got a farm and a recycling business. So what's happened here is they've got a 520 kilowatt of biomass system. Now they're buying a biomass system that's Polish. So traditionally we look at good German ones like Gunmatic and those sort of things. This is a biocompact. So it's a well-known supplier, it's Polish. I guess if you're looking at the equivalent in cars, where some of the German ones are Mercedes, is more Ford Focus, but it's still produces a burner, can burn lots of other things other than just wood. So he's putting a lot of his waste straight into that, so his cost for his feedstock is actually 0, which is very useful to have. So within that proposition there and financial analysis, he's got £102,000 of income per annum from the RHI. We funded it at 3.3 fixed flat rate, which is a pretty good rate, not exceptional. And with all asset finance businesses, they calculate the rate they charge you, rate for risk. So they look at your credit covenant and say, we think you're good for this rate, we think you're good for this rate. So you'll know those sort of things when you're dealing with banks. Because it was a relatively large project for a small business, they funded it in 4 or 5 stages over about 4 months. So we funded it over stage payments. So the first stage would be when the biomass system was shipped in from Poland to the UK. So we paid the supplier the first element. As the commissioning went along, we then paid further stages to make their cash flow for the customer nice and easy. The administration fees for dealing with that was just £200 for £330,000 lend, which is nothing. And we sorted out repayment in line with what the customer's requirements were, 5 years, in arrears, quarterly. So what happened was we try and tailor the income, the repayments, in line with the RHI or FIT income. So you get your income from the subsidies quarterly in arrears. So we try and tailor the outgoings against the finance project quarterly in arrears as well. Again, try and improve cash flow. Okay, so that's one project. His expenditure, including the repayment of the loan and the interest, came to 62,000. So you can see just for that particular project, and paying for it over 5 years, he's £40,000 a year net profit from that particular project, and thereafter, 15 years thereafter, he's tied in with those 15 years worth of RHI income with no further payment at that stage. So he was delighted with that. And I say it wasn't a particularly well-known supplier, the buyer compact, but we did our research, did our due diligence, took the funder with us. The funder was keen on it, understood it, did their diligence and said, yeah, we'll lend money against that project. And that's paid out a couple of weeks ago. So he's a very happy customer with that one. More interesting because, as I said before, lots of people have put projects in the past, spent good money on it, and now they might like to look at battery storage or other projects that Catherine and George were talking about, but working capital is perhaps tighter now. So this is a small solar farm we did down in Devon, and they invested 700,000. Now the key to this was the chap put some of his own money in and borrowed some private equity money as well, because at the time he was investing in a project. The asset finance market wasn't ready to invest in projects at that time, so he had to borrow money at 12%. So he invested some of his own money in some private equity. He was quite keen, and I met him 18 months ago, and for 18 months we were trying to get a funder interested. And he was just quite keen to pay off the private equity so that he wasn't paying 12% money on it. So we were looking at it, and how it works on a refinance, you work out through the cash flow of the project as how much you can lend against it. Okay, so in his instance, his FIT income was £96,000 a year he was earning from the feed-in tariff. And his running costs were about 23,000. He had his mate down in Devon going around doing things for him, so it was all done on the cash in hand, and there wasn't a lot of money involved in it. But he was making about 70,000, just over 70,000 a year after his costs. So what we did with this, we took the funder with us, we met this chap, and what we said to him, okay, we'll work out from that 73,000, we'll fund it over a further 7 years for you, because we know therefore we're still going to have 10 years worth of income after that, so you're still going to earn money at it. But what we didn't want to do is make his cash flow suffer at the same time. So we worked out, going back 7 years, at £73,000 a year, we worked out, based on a 3.5% fixed rate, that we could refinance £511,000 for him, which allowed him to pay off his private equity, which meant suddenly he's got his own cash in, he's got 3.5% now, rather than 11 or 12, and he's got £500,000 then to reinvest in other renewable projects. And the fee for that, for doing that work, was 500 quid. Okay? Now, I'm not going to knock the banks. I used to work for a bank, lovely people. They charge an arm and a leg for simple stuff. This is quite complex, and £500 for that, for all the work we did and the meetings we had and the visits down to Devon, is no money. So the asset finance market is quite good in terms of they're not trying to take money out for fees for not a lot of work. They're quite good. They do low administration fees, and they're doing really commercial business rates now on these projects. We work with a couple of quite enlightened funders who are saying, well, we actually now think we can offer project finance. Project finance used to be an area where it's quite costly from a funding perspective because of the due diligence you do on it, the lawyers' work you do on it, accountants' work you do on it, excuse me, where there could be quite excessive bills in some of these things. You can spend 30, 40, 50,000 pounds easily if you put all those things together. So some of the funders have come up with a low-level due diligence package and say, we can do these things now, we think, by doing a lot of stuff in-house for a couple of million up. And I put on there 1 million, and we have had a look at £1 million deal, but generally £2 million, where you're just saying, okay, we've got a project, we can work out what the financial analysis will be based on our income and expenditure, and we think by borrowing a couple of million or 3 million, we can make this work on a financial basis. There's no trading entity behind it, so these people take a risk on just looking at the financials of the project. They're looking at the costs, and what they ask for is perhaps a larger contribution from the project holder. So quite often they'll say between 10 and 20% as a contribution to the project, allows them an element of security in the deal that they feel comfortable to lend 80% against these deals with no other thing in their pocket other than a business plan. So we're working on a wind turbine project at the moment, 2 or 3 of them actually. And this one I'm just doing at the moment is a community benefit scheme. So this is where the local community, the project developers and a landowner have all got together. The landowner's provided the land, the developer's doing it, and the community scheme, this is in the Forest of Dean, and they're basically saying we're going to go thirds on the income developed from the project. So what's happening is at £1.3 million, they're looking to get projected fit income of 279,000. The running costs are 232. So it's £47,000 profit in this on the projected figures. Now they need to hit these figures, obviously, but based on the figures and the analysis, the funder is keen to proceed with this. They're doing their due diligence now, and this is going to happen in about 3 months' time. The build is going on at the moment. So what happens thereafter is part of the project income goes towards the community, so they're buying things like school playgrounds, dustbins and lighting and all these sort of things. But the landowner and the person who's developing it are also sharing the income as well. So another way for you not to take the whole risk, but we were talking about developers looking at landowners, and again this is another thing. And also from a planning perspective, what they found doing these community benefit schemes, they're doing 2 or 3 others, is they seem to go through planning much easier if you're benefiting the community that the planning is taking part in. So they are looking at another project in South Wales, and one in Scotland, larger projects, but based on exactly the same model. So again, that could be an opportunity where if you're living in a particularly windy area, there's an opportunity for perhaps a community benefit scheme, which I don't know if you consider, you might like to consider, because that seems to be a model that they're working well with, and they've got lots of opportunities building because of their profile and what they do with these sort of things. So there were the 3 things that asset finance covers. So normal asset finance with a trading business, it could be, as you say, it could be your farm, or a farm. Refinance of something you've already done a number of years ago and you can take money out of to reinvest in a future project. And project finance is something that's relatively new, but I say we have 2 very enlightened, engaged funders who are keen to progress with that, especially on things like community benefit schemes and those sort of areas. All right? I think it's about 12 minutes, I said 15, but there you go. So thanks very much. Any questions at all?